The oil price is going to continue rising until Trump just one day says it's over. If you think about some kind of massive detonation in the oil market supply chain in the Middle East, and there's this shockwave that's kind of moving out, this shock is too large for the system to handle, and it will begin to creak and break the longer this goes on.
Just how many barrels per day were those disruptions, the squeeze of 2008, and how big is this in comparison?
It's bigger than anything in history. Every analyst I speak with, people again that I respect, people that are not alarmists, people that make fun of the alarmists, they're all terrified. Let's say the East-West pipeline is maxed. There's no issues at Yanbu. The Houthis don't get involved, et cetera, et cetera. In that scenario, with the Strait remaining closed, we still need to shed 15 million barrels a day of global demand. And that just means prices, $250, $300 a barrel Brent. Like we will hit all-time highs in that scenario on an inflation-adjusted basis, almost guaranteed, almost by necessity. So I do think in that scenario, again, recession is too light a term. We're talking depressionary.
We have a special episode of Monetary Matters today with one of the best independent oil and energy analysts, Rory Johnston of Commodity Context. I've been utilizing his research to help navigate oil and energy markets, especially now during the Iran oil shock. Today, we have a special offer for Monetary Matters listeners. You can get a 20% discount on annual subscriptions to Commodity Context by clicking the link in the description. One key point Rory emphasizes today is how, even if there's geopolitical de-escalation, this is likely to be a protracted crisis. If you're an energy tourist like me, I think this analysis is a must-have in 2026. So go check out the discounted offer using my link. And remember that on Substack, if you aren't already subscribed, you must first enter your email to access the discounted checkout page. Let's get into it. I am joined today by Rory Johnston of Commodity Context. Rory is one of the best barrel counters in the oil business, and we need barrel counters right now. There's so much disruption and confusion in the oil market. Rory, great to have you on Monetary Matters. Welcome. You write, fundamentally, the normal flow of traffic through the Strait of Hormuz must resume or the oil market will break the global economy. You wrote that 1 week ago. Where do we stand right now in the middle of March?
We're beginning to break. And I think it's very clear that as of yet, the Strait of Hormuz has not normalized. In fact, the situation in the Middle East seems to be getting worse, not better. We've expanded yesterday to facility attacks. You saw very kind of severe attacks against Qatar's LNG facilities in the north, coming off the North Field, following Israel's attack on the Iranian South Pars field, which is they're part of the same gas structure in the Gulf. And we're seeing attacks spread. As we will talk about, one of the main rerouting outlets for Gulf crude, particularly for Saudi crude, is the massive east-west line that shuttles barrels to the Red Sea. And we saw attacks overnight that were confirmed on the port and on the refinery at Yanbu. So we're seeing this situation continue to devolve, and it doesn't look like things are going to get better anytime soon. But as I will hopefully describe to you, they have to. Otherwise, things are going to get truly, truly awful. And so awful and so politically untenable that my bias here remains that something has to move, which in my mind is Trump, because he's the most movable of the three participants in the war by market means. And I think that's where this has to end. And I'm shocked we are this deep into it already.
So you think that the price of oil is bound to go so much higher that someone must relent, and that is looking like to be the United States and President Trump?
Yeah, and just to kind of contextualize why I'm saying that. So let's just say, roughly 20 million barrels a day of oil flows through the Strait. We have some offsets, this east-west pipeline, for instance, that could maybe, in an optimistic world, shave that from 20 to 15 million barrels a day of loss. We also have the SPR releases. We have Russian oil and water. We have all these things that can float us temporarily. But just to put in context, if the Strait does not open, and we even have that 15 to 20 million barrels a day of loss that will need to be physically shed from demand if we cannot get supply reestablished, because no source of supply, even U.S. shale, which is the fastest responding source of supply in the market, it acts too slow. We're talking probably 6 months at a minimum to see a major production response, and even that will be insignificant relative to the need. So we're going to need to destroy demand. And 15 to 20 million barrels a day of demand, just to put that in perspective, that was the peak of COVID demand loss in March and April of 2020, when you and I were stuck at home, when there wasn't a plane in the sky. We would need to recreate that level of demand destruction, but without a pandemic and without lockdowns, just through price mechanisms alone. And I have an extremely low price sensitivity to gasoline prices. I'm getting my kids to school regardless. But that just means that we're going to ratchet higher and higher and higher until we shed it somewhere. And that's likely going to mean in poorer countries in the global south, which is going to manifest for them as outright and likely deadly shortages of these fuels, these critical fuels for these economies and these people. And in the global north and advanced economies, it's going to manifest as a all-time high, debilitating price shock that will cause all the normal recessionary concerns and sapping of disposable income. And if this goes on any longer, recession is the best case scenario. We're talking depressionary conditions because it's just such a big shock. And it's just hard. And it's one of these things like I try to think of myself as not an alarmist. If anything, I usually get a reputation as like a bear in the oil market. Like I'm like, the oil market will solve this. The oil market's extremely flexible. We've seen this repeatedly over the past half decade. The market is shockingly good at absorbing and rerouting flows. This shock is too large for the system to handle, and it will begin to creak and break the longer this goes on.
So 20 million barrels go through the Strait of Hormuz, or used to go through the Strait of Hormuz. How big of a disruption is that? Has there ever been a disruption as big? The Yom Kippur War, the 1979 Iran-Iraq War in the 1980s. Just how many barrels per day were those disruptions? The squeeze of 2008. And how big is this in comparison?
It's bigger than anything in history, even proportionally. Maybe you could go back to like the early days of like Rockefeller, and maybe there could have been a specific outage that was proportionally larger, but it was still such a nascent industry at the time. So base effects were playing a lot there. But just in terms of context, like the last greatest shock in the oil market in terms of supply shock we dealt with was following Russia's invasion of Ukraine in 2022, when at the peak of that fear, the IEA published its April oil market report, and the fear at the time was that it was already a tight market. We were already kind of grinding higher. OPEC wasn't keeping up, et cetera. And the IEA said that Russian supply could fall by 3 million barrels a day, which at the time I was like, oh my God, that's insane. Like how are we going to come out of this hole? This is 7 times larger. At least 5 times larger, even taking account for, let's say, the east-west diversion out of Saudi. So it's just massive. When we look back at even the 70s shocks, I think a lot of people remember them as a supply crisis, and they were to a degree. But a lot of it was not an absolute loss of supply, but rather kind of a selective rerouting. The Arab OPEC nations, blockaded or didn't ship oil to Western nations that were allied with Israel, but they were still shipping oil. And as we've talked about through all these other crises, barrels have a really, really good way of kind of solving themselves and figuring out flow and filling holes. And, traders are going to arb into, and close these arbitrage opportunities. Same in 79. You saw a loss of oil briefly, but it was more a logistical flow. And most of the research looks back at it was more of a precautionary demand shock where everyone kind of panicked, bought, tried to scramble for barrels. And, the supply loss wasn't actually as great as people were fearing. This is multiples of any of those events already. And we're beginning to see the precautionary shock. In addition to this, basically Asian refiners scrambling for barrels. But shockingly, we're sitting at $114 for Brent right now. I think this morning we peaked at just over 118, which is higher than even 2 Mondays ago when we busted higher coming out of the weekend. That's high. But it's not high enough. And I think it will continue to grind higher the longer this goes on. The way I've been describing this is essentially, if you think about some kind of massive detonation in the oil market supply chain in the Middle East, and there's this shockwave that's kind of moving out. People are like, why is, right now, for instance, physical cash Dubai barrels off the coast of Oman are trading at over $150 a barrel. You're like, well, Brent's at WTI's like 100. Why aren't people buying WTI? Well, WTI contracts are for delivery next month. Then it takes another month or so to get them to where they're going. So the issue is it's a acute scarcity issue in the Gulf right now for crude. There's a time issue that we can't get any barrels to fill that hole quick enough. But as we saw kind of yesterday, I believe we started getting reporting that Asian refiners that had been avoiding trying to go for these further afield barrels are like, surely this is going to end. Surely we won't need to do this. They're finally coming to the conclusion that, oh my gosh, maybe this won't end. And they've started buying in the Brent basket. And we're going to see them start buying in a WTI because they're going to need to start filling not the current hole, but the hole in 1, 2, 3 months. And that's how we know that this is going to start spreading to everything else.
And so in 2022, the fear from the International Energy Agency was a 3 million barrel disruption from Russia. You've got a great chart. We can show it that actually the disruption from Russia was a very, very small. So that didn't even happen. And what it's looking like right now, the disruption from the Strait of Hormuz with Iran could be 7 times bigger than what the fear was in 2022 that didn't even happen. And of course, in 2022, the price of oil spiked and went well above $120.
Correct. And what we're talking about right now is just the supply loss. So this is the loss of flow through Hormuz. But on top of that, we also now have confirmed massive production shut-ins across the region. So basically, the rationale here is that because countries, oil flows, it has to go somewhere. It's kind of like electricity in that way, that you need to put it somewhere. And if you can't put it somewhere, it has to kind of get shut in because you can't just like spill it onto the sand in the Arabian desert. I guess you could. But anyways, because when you run out of the capacity to ship this stuff afield, so tankers are loaded, they can't get out. Then you start filling inventories. Then inventories overflow. And when they overflow, you're forced to shut in. We saw this actually, I'm a Canadian oil analyst. We saw this in Western Canada in 2018 when pipeline bottlenecks caused shut-ins in Alberta. It's the same functional idea happening right now in the Middle East, but at a much more massive scale. Right now, we already have confirmed upwards of 9 million barrels a day of confirmed shut-ins. This isn't just supply loss. This isn't the Hormuz stoppage. This is actual barrels that have stopped being produced. And again, going back to that fear of 2022 in Russia, that was 3 million barrels feared, maybe 1 million barrel a day realized for a month or two. This is 9 million barrels a day already confirmed. So we're in deeply, deeply uncharted territory.
Yes, you're saying that if it just was the Strait of Hormuz being blocked, once that Strait of Hormuz is open again, which hopefully is very soon, all of the oil could get out of there because it's just being stored. But because there's not enough storage, the actual production of the oil has gone down. You've got a chart showing 3 million barrels not being produced by Iraq, Kuwaiti oil, 1 million barrels. Talk to me about the scale. Of it right now. So 9 million barrels not being produced. Do you see the production going to go even lower, a greater disruption than 9 million barrels? Also, let's say the Strait of Hormuz is opened, right now, today. How quickly can that production come back online?
Great question. So let's talk about the different ways the Strait of Hormuz blockage and this overall situation is affecting different types of supply and production in different ways. So I think there's 3 big buckets here. So the way I've been describing the Strait of Hormuz stoppage is basically like a kinked garden hose, right? To your point, you unkink it and flow can start again. I think at this stage, it's been kinked for so long. Now we're going to experience the type of, supply chain bottlenecks we experienced in COVID. All these ships are going to be on top of each other. They're going to try and unload at the same time. It's going to take weeks, months to kind of unwind the tanker bottle up basically. But fundamentally, you can reopen it and things start flowing again, assuming that people trust Iran and all these things. But theoretically, it can happen. It's physically possible. Now we have the shut-ins. So this is what we were just talking about. This is barrels that have actually been, they've capped the wells, or they've basically, stopped the barrels from coming out of the ground. Producers don't like to do this because it's expensive, it's risky. You can potentially damage the ultimate recoverability of these wells. Because remember, all of this is produced by natural pressure. So anything you do to muck with that normal flow can cause negative side effects in the longer term. But I think even in the best case scenario, we're talking weeks to months to get these barrels produced again, back into kind of full production. So I would say probably months to get back up to full normal Middle Eastern production. And again, if they can even do that, if there's no kind of long-term consequences to recoverability. And finally, I think there's this final piece to this that is even worse than the other 2 buckets, which is if there are facility attacks, like what we saw overnight in Qatar on the gas plants, what we've seen in other areas threatened already. That's when, if you hit an upstream production facility, if you hit, for instance, back to 2019, that's when Iran hit the Saudi massive, largest oil processing facility in the world at Abqaiq. And that is actually, Abqaiq is the point at which oil begins to flow through the East-West pipeline. So obviously this is all connected, and obviously obviously Iran knows this. So that's very tempting. If they start hitting those facilities, then we're not talking weeks to months. If we go back to the garden hose kinking, it's not a garden hose anymore. That's like taking the shotgun and blasting off the faucet to which the garden hose is attached. everything in the oil market is repairable, but that is not weeks. That's months, year, potentially or more. And that's the real nightmare scenario, because then we're that's the tipping point, because then there's no real immediate recovery from this, and we're going to need to shed massive amounts of demand to cover the gap.
So 20 million barrels through the Strait of Hormuz. Let's say that, be generous, let's say 10% of it is still flowing through from Iran and stuff. So 18 million barrels off the market. How much can get through other means, through this east to west pipeline, through Saudi Arabia, through, I don't know, going up through Russia? How much, what else can be done to fix that?
So this is actually the next piece I'm working on, and I've been trying to get it out, but it's been chaotic in the best of times. So hopefully the subscribers will see this piece soon, but a little preview. So just to be clear, so out of that 20 million barrels, roughly 15 million barrels is crude oil, and the other 5 million barrels are refined products. And we'll talk about refined products too, because that's even in some ways a more acute crisis in the immediate term. But overall, 20 million barrels of oil proper. Let's say we have the Gulf reroute. So this is the east-west pipeline. I would say
through Saudi Arabia.
Yeah, for Saudi Arabia. So this is also the Petro line. It was actually a line that was built in the 1980s during the Iran-Iraq War, during the tanker wars, specifically as insurance against this current and exact risk. So it's now serving its purpose. Then the pipeline has a nameplate capacity of 5 million barrels a day. Saudi Aramco has said they could push it to 7 through the use of an associated NGL pipeline, or natural gas liquids pipeline. There's probably only already 2 to 2.5 million barrels a day flowing through that to the West Coast anyways, just because there are settlements on the West Coast and there are refineries. So let's say, optimistically, you can get 5 million more barrels. This is where I went from 20 to 15 in that kind of optimistic scenario. That's one path. Let's talk about some of the issues with the one path. Obviously, it's a pipeline, so it can be bombed. It has pumping stations which can be bombed. It terminates at the Red Sea, which up until very recently was being terrorized by the Houthis, which are Iranian allies. And last night, we actually got confirmation from the Saudi Ministry of Defense that a ballistic missile and a drone were shot at the port and the refinery at Yanbu. So clearly, this is now becoming a target. And after Israel targeted and hit the South Pars field yesterday, Iran released a list of targets, one of which was the refinery at Yanbu. So we knew this was on their radar, and now it's also been confirmed. So that's the biggest single one. Let's say charitably 5 million barrels a day, although there's lots of asterisks and kind of question marks around the sustainability of that. The next is the pipeline in the UAE, which basically links the Gulf side of the Emirates to the Gulf of Oman side. And this terminates
is the good side that currently is not being blocked. Yeah, it's
again good. I like this. I've been adopting this terminology as well, the kind of good and bad side of the strait. So it travels from the bad side of the strait to the good side of the strait, and it terminates at the major kind of blending and shipping hub of Fujairah, which, if anyone follows this market, those are the Middle Eastern weekly inventory stats that we get is for Fujairah. That pipeline has theoretically upwards of a 1.7 million barrel a day capacity. Probably 1 to 1.2 were already flowing on the line. So let's say charitably, we can get 0.5. So now we're at 5.5. And again, with this Fujairah pipeline, the other issue there is that Fujairah has been repeatedly hit by drones. You've seen the storage tanks on fire. You've seen shipping stop and start. So it's going to be hard for that to be a sustainable and secure offset. Okay, so let's say we're at 20. Now, actually, and you're right. So Iran is still shipping. So let's take out 2. So that's 18. Let's take out 5.5. So now you're at 12.5 million barrels. Am I doing that math right? Yep. Okay. Now what can the West do? What can the consuming nations do? So far, we've seen the main response here has been from the IEA's coordinated strategic stock release, which is 400 million barrels. We still have yet to get exact specifics on all of the various timelines for those. But what we've heard from the United States and from Secretary of Energy Chris Wright is that the U.S. portion is going to be completed over 120 days, so 4 months. If that is applied to the full 400 million, that gives us a flow rate, which is the part that matters here, is like the realized supply aspect, about 3.3 million barrels a day. Okay, so that could last 3.3 million barrels a day for let's say 3.5. Let's be generous to keep the math easy. So now we're
9 million.
We're 9 million there. And again, that's time bound. So that only lasts for 4 months. Then we have excess Russian supply, Russian oil and water. And again, one of the things I've been pressing here is that Russia is the single greatest beneficiary of this war in Iran. I don't say a lot of nice things about the Trump administration, but I'm going to say, like, to their credit, they did a very good job at tightening the noose around Russian oil trade over the past 6 to 8 months, following the sanctions on Rosneft and Lukoil last October, and following the imposition of punitive tariffs on India for Russian oil purchases. India more than halved its purchases from over 2 million barrels a day to about 1 million barrels a day. There was real strain on that. And because of that, you had Russian discounts on their crude blowing out. You had Russian oil and water rising to deeply, elevated levels. That's a sign that the sanctions and the tightness was working. But that has now also created a little bit of an offset because we can tap those Russian barrels. And what we've seen is that basically in 2 weeks, all the progress the Trump administration had done over 6 to 8 months has been undone. So basically, Russia is everyone's kind of preferred barrel of choice because it's a major producer. It can put it can load and ship into the Pacific Basin, and it's not on the wrong side of the Strait of Hormuz. So that is likely going to continue happening. Roughly, you're like, let's say 60 million barrels, or upwards, let's say even 100 million barrels of Russian oil. Depends on where you exactly benchmark where the normal is. But we're looking at maybe, let's say that draws down in a month, because I think this is actually the stuff that's going to draw down fastest. Because you've also seen the U.S. Treasury Department issue an explicit sanctions waiver on Russian barrels that were loaded prior to March 12th. So this is explicitly talking about these floating barrels and this kind of oil and water that I think, again, and also exempted sanctions on any of the shadow fleet. So basically said, if there's a Russian barrel on water, go buy it right now. And we already saw, I think it was yesterday reported, that India bought 30 million barrels of Russian oil that was sitting on water. I think that's probably in the ballpark of, let's say, 60 million barrels over a month, let's say 2 million barrels a day. So now we're down from, where were we? 9.5 or 9, back down. So now we're at 9. Yeah. So now we're at 7. That's still a gigantic hole. And this is where, there are other offsets here and there, but really that's when this is going to begin to fall to other oil and water and other commercial inventories. And again, about half of that offset is temporary. This only lasts for so long. So the longer this goes on, the worse this gets in basically every single way. But that's the offset. And I think that the worry I have here is that again is an untenable situation. We will see prices continue to skyrocket over $200 a barrel Brent. We already have over $200 a barrel jet fuel in Asia. We have $150 Dubai cash basis physical crude in the Middle East. This is the way this is heading the longer this goes.
Tell us about the refineries in Asia and the time lag between when they are going to start running out of barrels.
Yeah, so I've been describing this essentially. If you think the oil market, the reason we talk about it in millions of barrels a day rather than like monthly tons or whatever else is the market works, and it's best to think about the entire thing as basically a pipeline connected flow system. It's a stock and flow model. The world's biggest chemistry set, I like to say. And this is, so you need barrels flowing all the time. And as soon as they stop, you basically create these air pockets in the system. And right now, let's say you had, again, 20 million barrels a day. I think what are we in the 19th day of this? Let's say 20, because by the time this goes out, let's say, that is 400 million barrels of air gap or air pocket that's essentially emerged in the X kind of Gulf trade. So the trade that's coming out of the Gulf, largely heading to Asia. Those barrels typically take, let's say, 4 weeks to get from the Middle East to where they're going in India and China and the rest of Asia. So it's not going to be until those barrels hit land that basically this really begins to tighten. Because again, 3 weeks ago, we still had crude laden tankers leaving the Gulf. So those likely still haven't landed at their final destination yet. Probably they will next week. And after that is when this is going to really start tightening. And to your point about Asian refineries, refineries are the ultimate consumers of crude oil. We don't consume it. Very difficult to consume. But these Asian refiners are their worst case scenario is shutting down. They don't want to run out of crude feedstock. Initially, very frankly, I was like, well, they're just going to chase these sky high refining margins. And my, very, very wise kind of analyst I know on the refining side is like, actually, they're going to be terrified of shutting down because it's expensive. It's complicated. They could be off for weeks or months, and they're going to get none of these refining margins. And again, especially if you think they're going to get worse, You actually want to be in this as long as you can to capture the ones on the other side. So they preemptively,
if they run out of crude oil to put into the refineries, that they have to shut it off, and that's very expensive. They don't want to do that.
Exactly.
So they're turning down their production right now, even though the profit margins of refining crude oil into refined products is already so high.
Exactly. So, and let's say, for instance, the refinery is running at 90% normally. What we've already likely seen is them reduce that to say 65%. So not all the way, because they still have to operate at some base level of operational capacity in order to keep everything flowing. But they're trying to do that so they can extend their runway of how long they have until they actually are forced to shut down production. So what you've seen is that air pocket in, Middle East to Asia trade, that is still taking a while to hit land. But the realized tightness in refined product markets is already slamming Asia because they turned down immediately. And that kind of immediately went into the Asian market. We were talking about jet fuel a second ago. Jet fuel in Singapore spiked, I think in the first week, over $200 a barrel equivalent. And that's because a couple different reasons. Jet fuel, you don't keep as much inventory because it's very, very delicate and kind of specific in its specifications, I think reasonably so. But you cut out the jet fuel from the supply side. You don't have a lot of inventory cover. And then basically every Asian airline that was like, oh my gosh, I may have hedged a little bit, but not nearly enough. Now they're all scrambling to secure physical barrels. So there is also this precautionary demand. So basically this really, really liquid market basically blew up. And that is going to be how this continues to happen because we're talking about the necessary demand destruction that this has to see in order to kind of clear this market. That is not going to be crude oil alone. I think crude oil is one way it's going to manifest, but ultimately, again, we don't consume crude oil, we consume refined products. And that's where this is going to kind of bite the hardest. Jet fuel is one. Middle distillates overall are the tightest part of the market. So jet fuel, diesel, gas oil. We saw going into this crisis, we already saw diesel margins in the United States really high, between $30 and $40 a barrel, relative, like let's say a pre 2022 norm of let's say 15 to 20. They're already up to about 65 to 70. At the peak of 2022, where we last saw middle distillates really explode, you saw that hit between $80 and $100 a barrel. And I think if this continues, it's going to go keeping higher and higher and higher. And a part of the reason that, and in addition to the Asian refinery turndowns, part of the reason this is hitting diesel and Middle East so acutely is that the Middle East had become the primary supplier of diesel to the European market after Europe had banned the import of Russian diesel. So all of these, in some ways, we're still living with the consequences of distorted supply chains coming out of 2022. And this is just taking those already strained supply chains and kind of crushing them into oblivion.
Rory, in the United States, we have a lot of refineries.
Yes.
Tell us, how does this impact the United States crude oil market, but the refined products market, and specifically gasoline, the price at the pump?
Yes. So I think that's the next phase of this, is how these countries are going to respond on a domestic policy basis. And the United States, as everyone by now knows, is the world's largest producer of oil. And you've even seen President Trump begin shifting his narrative around lower prices are better to we're the world's largest oil producer. High prices are great for us, which again is actually one of my most concerning signs about how long this is going to go. Because if he's beginning to convince himself and kind of shift those goalposts, we're not in a great position there. But how does this affect the United States? If everything stays the same, the United States will, on a lagged basis, feel the exact same thing as everyone else. Because again, that shockwave is moving out. And eventually, the United States still imports crude oil, even though it's a net exporter of petroleum now. It still exports crude, which is light sweet from the Permian Basin. It still imports kind of medium to heavy sours, largely from Canada, but also from other countries internationally. And I think also really importantly in this context is the individual regions in the United States. So what we would call PADs, which they're EIA terminology, petroleum areas for defense districts, a holdover from World War II. They are themselves unbalanced. So they need trade in order to balance their own slates between crude and refined products. For instance, the U.S. East and West Coast import gasoline. The U.S. Gulf Coast is a net exporter of diesel. What I think we could see here is the beginning of trade restrictions in the United States. Obviously, only a decade ago, it was still illegal to export crude from the United States. The Obama administration repealed that, I think, in very, very good fashion, because otherwise the United States shale patch would not have grown to the level we have right now without that export capacity. But particularly in a crisis, and particularly using the language of the U.S. as energy independent, the obvious move for the Trump administration here is to begin restricting trade and keeping that from leaking out in the world, particularly when we're talking about major SPR releases.
Strategic Petroleum Reserve.
Yeah, yes, Strategic Petroleum Reserve. Well, one of the scandals we saw in 2022 with the Biden Reserve is that some of the SPR releases end up in China. Because again, these are freely traded barrels. You're going to release them. They're going to go to where they're most demanded to fill the best hole they can. And I don't think Trump is going to like that. I think he's going to want anything the U.S. does to benefit the U.S. consumer directly. So the only way to prevent that from happening is to restrict trade. Whether or not that's a crude export ban or restrictions, or what I actually think is more likely is restrictions on the exports or trade of refined products. We actually saw the Biden administration regrettably mull this over in late 2022. It was a terrible idea then. It's a terrible idea now. For those reasons I was saying, that if you do have, let's say you ban exports blanket, which is, I think, the worst way this could go. You would essentially bottle up diesel in the U.S. Gulf Coast. Normally, the U.S. Gulf Coast exports 1 to 1.5 million barrels a day of diesel. The immediate effect of that would be very, very good from Trump's perspective. You would glut the local supply. You would force prices down. Already, diesel price in the United States, the national average is over $5 a gallon. So that would be popular to bring that back down. But without anywhere to put that diesel, the ultimate result will be that you would have run cuts at refineries in the U.S. Gulf Coast. And in no circumstance in this market should you see any major regions cutting runs. We need every kind of bit of refining capacity we can get, particularly in these kind of advanced markets. So they think that's the negative side. And the further consequence there is that if it starts a chain reaction of kind of trade restrictions, the U.S. East Coast imports gasoline from Europe. What happens if Europe begins to restrict trade? Where does the U.S. Gulf or where does the East Coast get its gasoline? You could actually have, this is actually another point that I think is leading us towards trade restrictions. You saw Trump this week repeal or waive aspects of the Jones Act to allow more shipping between U.S. ports, which does help actually in this situation. But the only way it really makes a lot of sense is if it's coupled with trade restrictions, which is, again, one more point that I'm very concerned about. They're heading down this path. But you could have a situation where, like, the U.S. is actually short gasoline in certain regions and can't get it because there's trade restrictions. And I had said it earlier that if we leave the system alone, we probably won't see physical shortages in advanced wealthy markets because we can pay for these sky high prices. But as soon as you start mucking with trade, that is where you can introduce the kind of potential for outright shortages, despite the fact that we could pay for those higher prices.
Got a lot more questions for you, Rory. But first, I just want to ask you, tell us about the work that you do at Commodity Context. It's been my guide to this crisis in oil in terms of counting the barrels, looking at the official data, looking at the prices, and then weaving together a picture of what's going on based on that sort of constellation of facts you have at your disposal.
Yeah, so thank you. So at Commodity Context, I publish typically twice a week. I publish a weekly every Friday called Oil Context Weekly, where I kind of go through everything from flat prices to time spreads, latest inventory data, speculative positioning, and kind of market positioning. It's released immediately after the Commitments of Traders report. So that's kind of my weekly wrap up of everything that happened. And right now it's about 100% about the Iran war. In addition to that, I have 3 monthly reports called data decks, which are essentially my versions of an IEA monthly report or something along those lines. I have one on global oil balances, North American kind of detailed oil balances. I do a lot on Canada-US trade, et cetera. And then also on OPEC kind of compliance and tracking and production and, official versus implied production. And then on top of that, I have thematic research, which a lot of it right now is, again, about the Iran war. And before that, it was all about Venezuela because Q1 has already been an absolute gong in the oil market. So I encourage you to check it out. And join me and along this path towards greater oil market context.
And just to give people a sense of how in-depth and data-driven and data, visualization-driven your work is, like, you have a chart of Libyan oil production, the capacity of how much it's producing, how much it's actually producing, and then its quota because it's in OPEC. So that's, just how in the weeds you are. And then also you've got a chart I was looking through, which was interesting to me, of like the trade volume of the WCS Houston versus WTI, the Western Texas Intermediate, and basically something a little, there's some new player in that market, like that's really spiked up a lot. Some people specifically trading the spread between Canadian oil and US oil. And yeah, so the work is really good, and I also think the like most oil research is from a bank, which you have to be a hedge fund to join. And some of the research is good. Like the Bank of America's fixed income work, I think is very good. But
Mhm.
like the bank wants you to put in trades, so it's always going to be like you should do this, you should do that. Rory does not have that, and what Rory is not biased to be a perma bull on oil. He happens to be, it sounds like, wildly bullish on the price of oil, which is a grave concern for markets and the global economy. But that's just based on his own analysis on the data, not because he's trying to get you to buy Brent calls or sell Brent puts or something like that. So we've actually got a discount for Monetary Matters listeners. People can get 20% off an annual subscription to Commodity Context. The offer ends in 1 week on March 26th. Annual subscriptions only. If people are interested, they definitely should take advantage of that. The price of oil has nearly doubled this year, just looking at Brent. And whether or not it doubles again from here, I think very highly of Rory's work. And I think it's crucial analysis and data that's visualized in a very, very helpful and honestly very, good, nice to look at way for professional and individual investors. Rory, getting back to it, I want to ask you, if the Iran war ended today and the Strait of Hormuz opened up immediately, and the Iraq, Kuwait, UAE, all these countries that have drastically reduced their oil production, boosted it back, and in a couple of days, well above your expectations.
Yep.
What is the best possible scenario? So what's your greatest bear case for the price of oil, and therefore a bull case for the global economy?
Yeah, so I understand this in two slightly different ways. I think let's assume in the most bearish case that the United States and the Trump administration wins the war today and the regime falls and we get some kind of emergence of a Delcy Rodriguez character like we saw in Venezuela. And not only does traffic through the strait resume, and not only does all of this kind of shut-in capacity come back by like the wish of a genie, but on top of this, you also have this massive reserve base in Venezuela, in Iran, which has been chronically underinvested in. That could open up to international investment. You could get a resurgence of Iranian supply. Yeah, there's a scenario that this, and again, if we remember, we were actually in an acutely oversupplied situation going into this war. So if we return to everything as normal and we had kind of the prospect of a lot more Iranian crude in the horizon, yeah, I actually think this could become a bearish situation. And for the record, I think that's what Trump thinks he's doing. And when you see a lot of the descriptions, I think there was a post a couple days ago about, how this is going to be better because you didn't realize it, but because of Iran, you were always paying, quote, a terror premium in the price of oil. So their thought is that after this, the Gulf is safer, shipping is safer, and kind of more Iranian production against the exact same argument as Venezuela. I think that is very unlikely. Let's just say deeply unlikely along that timeline and along those kind of clean lines. I think more likely, let's say it ended today and you ended up in some kind of weird quasi stalemate. That is when, let's again even assume that all those good things happen, but we don't get a regime change and we don't get it just goes back to the status quo, but we've lost 20 days basically of flow through Hormuz, and all the facilities are repaired instantly. At the most bearish, like the most optimistic for the global economy, we basically resume where we were, which was a oversupplied market that was continually torqued by Trump's sanctions and various policy. He returns to putting pressure on Russia, but we're 400 million barrels of oil, basically less in inventory. That I think, so basically we rewind to where we were in January or February, but with way less inventory cushion. So we have a higher steady state of oil, a steady state price of oil, even if things begin declining again from there. I think that's the most optimistic.
What was global inventories, global reserves held in commercial reserves as well as government reserves? What was that before? And now that we're 400 million barrels short, or will be, what is the new number?
So we need to wait for official data to kind of be more certain. But just as an example, we grew last year roughly, I think my official balance for the year was an oversupply of like 1.5 million barrels a day. And we saw kind of confirmed inventory estimates between onshore inventories and, again, oil and water, which had absorbed a lot of this, of roughly 1.4 million barrels a day. So over the course of the year, we're talking, over 400 million barrels that had built up in these systems. That basically brings us back and erases all of the surplus overbuild last year in basically the span of 2-3 weeks. And that's where we would kind of restart. And I think, again, that's the most sanguine view of how this could go. But I think that now let's talk scenarios. Let's talk how this could go, because I've been kind of going back and forth with every analyst I can talk to, basically being, okay, how could this even work? Because for me, the reason I come to this point of the Trump taco is my base case. I almost work to it backwards, that the consequences of leaving the strait closed are so untenable that something has to budge. And if we have 3 major participants in this war between the United States, Israel, and Iran, Israel's going to want to continue pressing its case. It's wanted to do this for decades. It's not going to let up unless it's forced to let up. Iran is not going to let up on its attacks against regional infrastructure and on its pressure on the strait unless it stops getting bombed. So those two are kind of already in this, and there's no kind of moving them in isolation. Trump is the only one of these 3 that can still decide to back out really at any point. There's political consequences to that, no doubt, but there's also political consequences, and I would argue more extreme ones, to keeping this going. So I kind of come to this in reverse of like, okay, it can't happen. It can't last. It has to end. So how do we, who is most likely to move? Trump is the only one who really can move, so it has to be Trump that moves. That's kind of how I come to this. But obviously, even in the scenario of a Trump taco, the situation is deeply unstable. And this war has destabilized this situation kind of almost permanently now. That even if this ends, the Iranian regime is still there. It has now bombed and attacked all of its neighbors. Everyone's pissed. Everyone's scared. A bunch of the Dubai markets are in free fall. It's popped this kind of dreamy bubble in the Gulf that these countries had built up for decades. And it popped them in 2 weeks. So I think that is durably challenging and problematic. And from the oil level specifically, we still have probably weeks to months to get this production back up and running. We have the supply chain bottlenecks of all these tankers sitting on top of each other and trying to get to the same place at the same time. And there's no guarantee that we get back to, even in this kind of quasi world, that we get back to a full resumption of 100 to 120 ships through the strait every day. That I think is the challenge that, it seems like Iran has said they want reparations. They want an explicit recognition.
Yeah, security guarantees, yeah.
Security guarantees. They want all of these demands. I think, personally, that if Trump just unilaterally stopped attacking and basically said, Israel, you need to stop attacking or we're going to stop providing the same level of missile defense or whatever else. There are levers to pull here. I think in that scenario, I think Iran might press this point for a little bit longer. Like, remember this, never do this again, even without a nuke. We're an existential threat to the global economy. But I think fundamentally, they also want to stop being bombed. For them, the survival of the regime is the only thing that really matters. As long as they survive, they win in their minds. That was the same line they had back in June of last year. So in that scenario, we've already seen them talking about some kind of tolling arrangement through the strait. They think that now, and we've even seen the Speaker of the Iranian House say, like, even after this war ends, the strait does not return to normal, which is going to be an intolerable situation for the global oil market, a deeply intolerable situation for the Gulf monarchies and the regional oil exporters. And I think that's the situation, is that I think there is an argument that we're too deep into this now, and that if this keeps going, and basically if Trump pulled out, like, there's still too much inertia. I think that's the risk here. I'm staying relatively Pollyanna-ish here, that I think he can taco, and I think that's the only way this can end. But I think there are legitimate counter arguments that this is already kind of pushed past a point of no return, at least in terms of durable oil market impacts.
And if in that optimistic Pollyanna scenario, what is the price of oil? Returning to pre-war levels of 60, 70?
No, I think even in that Pollyanna scenario, I think we're by, there's a floor at 90. I think probably we're kind of, $10, $20 structurally higher. And again, I think we could begin to work our way back down again if if markets return to a surplus. But again, I think that is the super Pollyanna situation. I don't think we're going to return to the exact same amount of supply we had prior. So in that scenario, things are structurally higher, and they're going to kind of stay higher for a while longer.
Now I have the opposite question for you. What's your most pessimistic scenario?
Oh, man.
Greatest bull case for oil. Clearly $200 is not that. Clearly it's higher.
It is. And I think I've been going with 200 because it was a nice round kind of scary number, because again, I think the oil market analysts have a little bit of a bad rep, and I think it's earned. A bit of the boy who cried wolf. There's a lot of perma bulls in the commodity sector generally. And I think generalists and kind of market observers are like, okay, I've heard this before. It's the end of the world, whatever. But like, this is legitimately different. This is legitimately the end of the current oil market as we know it if this doesn't fix itself. So what would happen in that scenario? We would need to, again, even in the most optimistic scenario, because again, the SPR releases and the Russian oil war, that's not sustainable. That can only go on for a couple of months at the best case. So let's say just again, 15 million barrels. Let's say the East-West pipeline is maxed. There's no issues at Yanbu. The Houthis don't get involved, et cetera, et cetera. In that scenario, with the strait remaining closed, we still need to shed 15 million barrels a day of global demand. And that just means prices, $250, $300 a barrel Brent. Like we will hit all-time highs in that scenario on an inflation-adjusted basis, almost guaranteed, almost by necessity. Now, again, some of that might be manifested in refining margins rather than crude oil specifically. I think that's going to be a hard thing to figure out the exact balance of, because again, we've never seen this type of shock manifest. But I think ultimately it will end up on crude oil most, because refining capacity isn't the main bottleneck here. It is the availability of upstream supply from the Middle East. So I do think in that scenario, again, recession is too light a term. We're talking depressionary. We're talking, a grinding of a halt of the global economy. All that stuff that we heard, again, all these scares that we heard back in like 2008 about the world's about to get a whole lot smaller, and air travel is going to become this weird luxury good that no one can afford. Like, that's the world we're talking about, which again seems like a disaster. And again, we're talking all of this is happening, and this is much more in your kind of general area, Jack. When on the general macro market and equity markets, this was all riding, the entire global economy was riding high on the most energy intensive technology we've ever developed, and now all of a sudden we have the largest energy supply shock in history. That can't coexist for long. And that will eventually begin to unwind as well. And then we have cascading financial crises on top of the physical shortages we would see, which is again why I think, like, I hope I'm wrong. Every analyst I speak with, people again that I respect, people that are not alarmists, people that make fun of the alarmists, they're all terrified, and they're all like, I don't understand how this continue. So that's why I come back to, I think it has to end. I think Trump has to end it, but how? And I think that's an open question right now.
Real all-time high in inflation adjusted prices. So that, the nominal high in Brent and WTI was $147 in 2008. So you think on an inflation adjusted basis, we get to even higher than that? Yeah,
I haven't checked the latest adjustment, but I think that the inflation adjusted, that was like $230, $220 a barrel in 2008. I think we sail past that. If it's a month and this hasn't opened, I think we're back up above $100.
And that is a very,
$200.
Yeah, thank you. That is a very brutal process by which the market forces consumers to stop consuming crude oil by literally causing it to go so high that people can't afford it.
Exactly. And I think one of the things we've seen so far, and I think there's a legitimate curiosity and question in the market of like, why aren't oil prices already higher? And again, that's what every oil analyst is asking, like, how are we not already at 130, 140, 150? How are we not already back at nominal all-time highs? And the answer to that is, again, I think that I think Trump has to taco. I think the market believes Trump has to taco. I think there's this bet, and we've seen so many episodes. Again, I never thought we'd get this deep into this crisis. All we've seen from Trump historically is big, flashy, cinematic kind of kinetic events, whether June of 2025 last year in Iran with the nuclear strikes. We saw that in Caracas when they got Maduro. Like, each of those basically lasted 3 days. And by Monday, there was some declaration of victory, and the markets kind of fell back down. The Monday after the nuclear strikes, we actually saw prices spike up by $5, $6, $7 a barrel, which is again expected because that was a big deal at the time. But by the end of the day, prices were down, end of the day, down more than $10 a barrel because Trump announced a ceasefire. That was what I and many others, and I think the market, have continued to expect. And we've even seen this from the physical market participants, that the reason that Asian buyers, Asian refineries, weren't bidding for further afield crudes is because they thought this surely has to end, and I probably won't need I won't need that crude 2-3 months from now. I just need the barrel today. But I think, again, over time and as that air pocket hits Asia, as this begins to manifest in physical data, as we begin to see inventory data, basically like the Looney Tunes plug at the bottom of these tanks, that's when I think the physical market is going to drag the futures market, by the nose higher. I think historically what we talk about financial markets and futures contracts leading physical markets. Because again, markets are forward looking. But what we've seen is that, again, 2 Mondays ago when we had that massively volatile Monday after open, it was the second weekend of the war. Brent hit, I think it was like $116, $117 a barrel. And then at one point was down $35 a barrel in the day. That volatility blew a lot of people out of positions. A lot of people lost their jobs. A lot of people were very wary of trying to get too long too quickly because, again, I think that level of price increase was likely justified as a forward-looking kind of panic of this. But then the jawboning. Trump came in jawbone. We've seen Wright jawbone. We've seen Bessent jawbone repeatedly. And every one of those times, we see prices fall by $5, $6, $7 a barrel in the span of 15 minutes. And that's a very difficult position to kind of get too far out on a ledge of anticipatory kind of panic. And that's why I think that we're going to need to wait for the physical market to kind of drag paper players by the nose higher.
I generally agree with the claim that financial markets are leading, particularly the stock market, the bond market and credit markets too. So, the stock market bottomed on March 23rd, 2020. And the economy didn't start getting better until the summer, but we had a ferocious rally in stocks, and that presage and was pricing in the future economic recovery that we thankfully had. Do you find that commodity markets generally and oil specifically are forward-looking mechanisms that price things in, or no?
But I want to answer that in two different ways, because I think what you're a little bit hinting at is this question of what does the curve mean? Because I think this is, everyone's talking about, you saw Hassett kind of talking about, oil is going to be back down at $50. Look at the curve.
Yep. So Kevin Hassett, who was in the White House working for President Trump, he said, look at the futures curve, and what he's saying is, in December 2027, December 2028, the market implied price of oil is far, far lower than the current spot price or the current front month futures price, because that's a backwardated market where future prices, forward prices are lower than near dated prices.
Yeah, and I think for a lot of people, they look at that and say that's bearish, right? Because they assume the market is forecasting that prices are going to fall. The first thing I want to cover is that's not how the futures curve works, at least not in physical markets. I think there could be an element of this in, say, rates futures, where there's no cost of carry, where there is kind of almost a frictionless element of this. But with physical commodities, the primary purpose of the curve, particularly the front of the curve, is spot market clearance. You're backwardated when you're tight because you're basically incentivizing prompt or spot barrels to flee inventory. You're basically creating an opportunity cost. Because let's say at the peak on that Monday, Brent prompt backwardation hit its all-time high. So this is the difference between the first and the second month contract, hit an all-time high of more than $9 a barrel. That means that if you had a crude barrel in inventory, like any, you could sell that barrel into the market today, immediately rebuy the barrel a month down the road, and you could basically rent that barrel to the market for $9 a barrel. That's an insane return. Anyone that didn't need those barrels was basically doing that trade because there was too much of a financial incentive not to. In the opposite, if you're in contango and the curve is upward sloping, what that basically means is the market is oversupplied and there's a discount or kind of barrels right now are less valuable because we have too many of them. And what that slope basically pays for is inventory storage. So when we hit at the deepest points of a weak market in, say, the bottom of 2020, in February of 2016, or the bottom of, March and April of 2020, when WTI hit negative prices, these were what you call super contangoed markets, where you basically, there's such a spread. This is where you can get these floating storage trades where a hedge fund will like literally rent a tanker, charter a tanker, fill it with crude, and just like sit it off the coast for a month or two and then basically dump it back in the market. That's how that market clears. So what we're seeing right now is that the market is extraordinarily backwardated, which means it's extremely, extremely tight. But I do not think, to like the Hassett quote, that's not what it means. It does not mean the market's pricing into the future. It means it's charging such an exorbitant premium today because people are so short and so panicked. But to kind of what I was saying about like markets being forward looking, I do think at the front of the curve, I think that there is this tendency, and we even saw this in 2022, that the futures curve jumped ahead. Prices jumped ahead of where physical markets were trading. And that's because there was this widespread anticipation of this demand coming down the line. And what we saw in that moment is typically when you see backwardation, you see inventories falling, because again, that's what's incentivizing it. One of the things we saw in 2022 that was evidence that this was anticipatory demand and concern, or what I call precautionary demand, is
speculation, you can call it.
Speculation, but physical market speculation, right? Not what we typically think of as speculators, as like the managed money component of the Commitments to Traders report. You saw inventories rising at the same time that backwardation was rising. So that for me is that there's like this precautionary stock building. You're like, oh my gosh, we're going to lose Russian oil. Let's build stocks so we have some stocks available. That I think is another way that's manifest, and I think what I would have expected to see in this situation. But I think that futures markets have gotten shaken out so repeatedly that now they're like, we're done. let the physical market take us the rest of the way, because eventually I think the futures market will get back into this. But I think they've been so shaken so repeatedly and kind of rug pulled repeatedly by the Trump administration that it's too risky to kind of get too far ahead of the physical market now.
So in 2022, the market was getting backwardated. Front-dated prices, spot prices were exploding higher, but inventory was actually rising.
Yeah,
you were tracking that work. Now inventories are falling. How much are they falling by the full 20 million barrels per day? And also, where was global inventories and global stockpiles before? And how low can it go? Like, could stockpiles go down to literally zero if all of China, all the US, Australia were just like, we're releasing the markets? The movie, the Titan or something, release the Kraken, release the barrel.
Yeah. So I think that, okay, so let's talk in the two phases. So our inventory is already drawn. Not yet. And I think this is this element of, I think the physical market has to see that first. And the markets need to see that real kind of raw fundamental data. And this goes back to this air pocket I was talking about, that crude scarcity hasn't landed in Asia yet. I think we likely will begin to see, and I expect to start to see, inventory drawdowns of refined products in Singapore, where we get the weekly data this Friday. I think that is something we will see. But I think we haven't seen the worst of it hit yet, because that air gap still hasn't landed. Once the air gap lands, that's where it's the Looney Tunes kind of plug at the bottom of the tank, and then you're like drawing 10, 15 million barrels a day of oil, at least in Asia, and kind of then spreading more globally. That I think is probably what's going to happen. I think it's probably going to happen over the next week or two as that kind of, the connection of the air pocket hits land. How large are oil stocks? It's a great question. They're huge. Like, just to be clear, the actual total volume of, again, when we talk about the oil market as a stock and flow model, the stock is basically oil that it has been produced, it has not yet been consumed. That's the kind of the general portion of stocks. That is probably around ballpark on a crude basis alone, or kind of crude and products, is about 8 billion barrels. So that is huge, just to be clear. But that a lot of that is operating kind of, buffer, which is why we typically look at inventories on kind of your seasonal chart, which anyone that follows an oil analyst will have seen these seasonal charts, because there's a normal seasonal pattern and a normal level of operational sufficiency to cover disruptions, to kind of keep everyone feeling safe, and there's no tightness and no kind of logistical, snafus. So I do think that, like, if we do 400 million barrels from global stocks, that might only be 5% of 8 billion kind of barrels, but it is obviously, that is a massive drawdown of what we're considering like the operational surplus. That again, we probably immediately go back to, we unwind the entire surplus buildup of the past year. And that is just over the first 2-3 weeks. The longer this goes on, then you start rewinding, all the previous ones, and we get back down to, very quickly inventory levels we saw in 2021, 2022, when prices were really, really high. And then we keep going lower the longer this goes on. And the other thing I want to separate here is there's a couple different types of stocks, right? I think people all think that, not all stocks are the same. And, some stocks are on water, some stocks are strategic, but then you have like commercial inventories. Commercial inventories are like the purest stock measure because they are essentially an economically incentivized residual of balances in the market. Oil and water, as we've seen over the past year, is if oil and water is rising, that is there's a stock that can be drawn down later, but that actually pulls from global supply as it's building up. So that is more of a kind of a loss as long as, let's say, Russian oil and water is exploding. Those barrels aren't being supplied to the market because they can't clear. And then there's also strategic stocks. Obviously, the IEA inventories we've been talking about, there's this 400 million barrel release out of roughly 1.2 billion barrels of strategic and commercially mandated stocks across the 32 IEA member countries. China as well has about 1 billion barrels of strategic stocks in crude, or let's call them inland non-pure commercial, because again, part of them are explicitly strategic, part of them are what we call, I think they would call them commercial strategic inventories, which again, these are state-owned enterprises. They're all SPR stocks at the end of the day. That is, I think, we will start to see that drawn down. But the longer this goes on, again, these are all finite stocks, and it can only go so far until we do run out of time. So I hope we need to draw down oil and water first, then we need to draw down strategic stocks, and only then are we going to start drawing down commercial stocks, because that's basically where the real evidence of the kind of realized market whole is going to be seen.
And these commercial stocks, what are they? Are they oil companies that just haven't sold yet? Are they refiners that haven't used it yet?
It's a bit of both. So you have both kind of refineries that'll hold stocks of crude on site, basically to maintain operations, as well as products on site to kind of maintain stable exports, again, just kind of evening out any operational dislocations. And then you also have like large trading firms. So you've got your Glencores, your Trafiguras, your kind of major trade houses, Vitol, et cetera. They all have their own stocks as well that they use to essentially arbitrage these time spreads in the market. They're typically held in like the major hubs. So in Cushing, around ARA, Amsterdam, Rotterdam, Antwerp, in ports in Europe in the North Sea, as well as, Hardisty in Alberta and Canada. These what we would call like merchant tanks. Those would be the ones that would probably do this first. I think by this stage, those are likely mostly already empty, because with backwardation of insane levels, these are the participants that are only holding these stocks for economic speculative reasons. So they're the first to shed, and then you basically get down to the actual commercial operators, and that's when, for them, for instance, I was saying, like, if you had a barrel in inventory when the prompt time spreads for Brent were $9 a barrel, you were selling that barrel. If you weren't selling that barrel and renting it to the market for $9 over a month, you were in a much, much worse situation, because you actually needed that barrel and you were buying everyone else's barrel that was trying to lend it to you. So that is, if you're in that situation, you need to maintain those flows. And going back to the example of the Asian refiners that are, preemptively turning down operations in order to not shut down permanently, those are that's the example. Like they're gonna keep doing that, but after they run out of crude, like it's endgame. Those refineries are off until you can refill those storage tanks, and then even then we have weeks to month to get that refinery back in operation.
And can these strategic petroleum reserves, can they get the oil out of the reserve into the market quickly enough? Because so let's say China has 1 billion barrels in reserve.
Yep.
It can't release that in one day, right?
It would be quite spectacular if it could. But you're right. I think so as an example, with a 400 million barrel a day release from the IEA, I've been treating that as roughly a 3.3 million barrel a day supply addition. So that's 120 days to get through 400 million barrels. If we used let's say we just use the similar kind of reference point for Chinese SPR, then we're going back to like, what was it? We're at like 7 or 9 million barrels a day of gap from Hormuz. That, I think, let's say we get another 3+ million barrels a day from China alone. The challenge with China is that China has already banned oil exports. So what we saw in 2022 was that China actually stepped in the winter of 2022, 2023, when crack spreads and diesel margins were exploding. You actually saw the independent teapot refineries in China swing into action as this kind of swing supply in global distillate markets. We've already seen Beijing short circuit that escape valve here because they've banned the export of refined fuels. I imagine they would also not allow the export of crude oil given the situation. So that
have they banned the export of crude oil from the Chinese SPR? They haven't done that yet, or no?
No, I haven't seen it explicitly, but I would
Okay.
say if they're banning SPR sales in, or sorry, if they're banning refined product sales, I would expect them to do the same with the SPR. And even if it wasn't explicit, they're only going to sell to domestic refiners who then can't export their product. So it would be a miracle if the Chinese SPR was able to help fill the gap globally. But I don't know if Beijing is going to feel like in a particularly charitable mood, given that, I mean, one of the big conspiracy theories of this is that, oh, this isn't a foreign policy mistake. This is Trump triggering purposefully a historic energy supply crisis to screw China, which I don't think. I think that's a little bit of sanity washing of this current adventure in the Middle East. But if there's any chance that China believes that, and China is obviously paranoid about its energy insecurity, which is why it built up the SPR in the first place, I would say that there's a chance that's going to feed into Beijing's thinking and reciprocating. I worry that the fact that Beijing has already banned exports makes Trump much more likely to also ban exports, to kind of say, well, China did it.
So we talked about time spreads, the fact that the price of oil now and in the next few months is so much higher than the price of oil in 2027, 2028. Talk to me about geographic spreads, the spread between Brent and WTI. I know, they're composites. Brent is like European, WTI is in Texas, as well as the price of oil in the good part of the Strait of Hormuz versus the price of oil in the bad part of the Strait of Hormuz.
Okay, so let's work out from the bad part. Let's start in the bad part. Crude oil prices in the bad part of the Strait of Hormuz are now deeply, deeply negative. Like, we're probably like, no one's assessing the price, but negative $50 a barrel. Like when we saw the negative prices in 2020, we're seeing that right now on the bad side of the strait, because otherwise you wouldn't be shutting in 9 million barrels a day of production. So that's our evidence there. So there's a huge arb value right now in literally just getting a single barrel across the strait, because if you're going from, let's say, again, theoretically, negative $50 a barrel on the bad side to physical crude, the next stage on the good side of the strait, currently trading at over $150 a barrel, you're basically talking about like a $200 a barrel arb on a 2 million barrel tanker, basically for going like literally like a couple hours journey across the strait. That arbitrage value is enormous. So that's your kind of initial thing, which is why, again, I think that the other side, well, we're going to see some demand destruction. The other thing here is that these price arbitrages are going to hopefully eventually incentivize more risk taking from tankers, that they're going to jump across and say, like, look, we can pay a $5 million kind of war insurance premium, which is the latest. We were talking about 5% war insurance premiums, up from 0.25% prior to the war in the region. And I think, and you could pay each of your crew, because obviously they're worried about dying, because this is actually like a life or death situation in the Gulf. You could pay them $200,000 premiums to make the journey. And that's multiple years of earnings for many of these seafarers. That I think is another way that this could clear. But again, it hasn't managed to incentivize enough flow yet.
That's oil in the bad part of the strait. You're saying it's negative $50 around there.
Yes.
Oil in the good part of the strait, which is trading at a massive premium. And then Brent, WTI.
Yeah, so then Brent and WTI basically are global benchmarks, and they're in the West. Brent is in the North Sea in Europe, and then WTI initially is priced in Cushing, Oklahoma, and then the main Brent that's exported is more WTI Midland, exported to the U.S. Gulf Coast. I think the challenge here is basically that all of those barrels take longer and longer to get out, which is why I've been thinking of this as like literally a geographic shockwave, that you're going to hit Brent first because Asian refiners can get those barrels faster than they can get barrels out of the U.S. Gulf Coast. But eventually, as this continues spreading, it will hit everything, because eventually the market is fungible to a large extent. There are additional complications here as well, that most of the barrels coming out of the Middle East are medium to heavy sours. Brent and WTI are light sweet crude, so there's not a perfect substitutability of them for Asian refineries. But I think even with that, like, people will take a suboptimal crude over no crude. And I think that's the situation we're getting in. So again, not only are we going to see big bids for refining, but because all these refiners are going to be desperately fighting for their lives and then likely processing suboptimal crudes for their refineries, we're also going to see, even on a per barrel basis, the product efficiencies begin to decline, because everyone's going to be working off of subpar slates. So I think that over time, this gets worse and worse and worse and worse. And at the same time, we've also seen freight rates explode, through this situation. So if you're further away, it then costs that much more to get to the Middle East or Asia. So I think this geographic aspect is really playing quite acutely now.
So the Brent has blown out relative to WTI. Brent, very often is at a modest premium to WTI, but now it's blown out tremendously.
Over $10 a barrel, I think, right now.
$10 a barrel. Do you expect that to maintain its very high level of spread, to widen even further, or to contract?
I think that over time, if this continues, again, all of this is predicated on if this current status quo continues, I think that I don't think you'd see that stay massively wide in perpetuity. I think eventually and again, unless you see trade restrictions. If you see trade restrictions, then it's going to go way wider because you're going to basically bottle up all of this WTI in the US that can't get out. And you're going to see massive discounts. You could see Brent at 200 and WTI at 70, like pretty easily in this situation, which is why, again, trade restrictions are really, really bad for the global market in this case. But I do think that over time that will normalize as more and more WTI begins being exported, and you basically Asian refiners begin to bid for those barrels, and the SPR release itself is finished. Because right now SPR release is bearing especially heavy on WTI specifically. And there's even talk, a bunch of really good more of your oil quant traders that are talking about how, because the US SPR release is being structured as an exchange rather than a spot sale, basically that means that whoever takes the crude has to basically pay it back volumetrically down the curve. So you return it in 2027 or whatever, but for a 20% volumetric premium. So barrel and kind interest, basically. So these participants need to basically hedge that at the same time, that exposure, if they're participating, which for them would likely mean selling the front and buying the back of the curve. So they basically secure that back barrel. It's almost like a flattener trade. So I think that's also adding kind of idiosyncratic weight to WTI that, again, is only temporary. So all of this will eventually kind of begin to phase out. One other thing I will just mention here, because I have to mention it. And again, this is deeply unconfirmed, and I think at this stage generally unconfirmable, but every trader, every oil analyst is talking about how it feels like the US government is playing in the futures market. And again, I think it's hard to disentangle how much of this is explicit shorting, potentially some kind of balancing hedge from Treasury on the SPR sale itself, or if this is just copium and basically the jawboning that we were talking about before is enough to basically have the same effect. But I do think that a lot of people are talking about, so I just want to mention, it is not proven, but I get questions about it every single day, and I have yet to see evidence against it beyond Besant saying, we didn't do it. But then prior, you saw comments from Burgum that kind of made it a little wishy-washier about whether or not they did it. So I would say that it's just something that people are talking about, and something to keep in mind is, again, if that was happening, it would manifest as idiosyncratic pressure on WTI specifically, because I doubt Treasury would be shorting Brent. They'd be wanting to short WTI. So again, unconfirmable, but I think one more element for people to watch about whether or not this continues.
Yeah, WTI is the oil in Texas. Besant, Treasury Secretary Besant has denied that repeatedly. Yes, I also know that traders are generally of the belief that it seems like something strange is going on. Another point, Rory, is just that to Energy Secretary Wright's point and Trump's point that the U.S. is a net exporter of oil and a giant, the world's biggest producer of oil, is the point that you said earlier. The U.S. produces a lot of light sweet crude, but not enough heavy crude, sour crude. Tell us about that. What are the differences there? And could the U.S. run short on heavy sour crude?
Yeah. So for the record, I'm Canadian, but I also say we. We're talking about the United States all the time. So
Canada has a lot of heavy. Right?
Exactly. So yes, the U.S. primarily produces light sweet crude from the Permian Basin and other kind of light, what's called light tight oil from the shale patches and other tight formations. That is increasingly exported because the U.S. refining slate has been designed historically to process more sour, which means more sulfur, or heavier barrels. Despite that, you actually have pushed more and more light sweet crude into the U.S. refining slate, particularly in the Gulf Coast. You've seen the average API density, which is a measure of how heavy or light crude is. The higher the number, the lighter it is, the lower the number heavy. The average barrel refined in the U.S. Gulf Coast has jumped over the last 15 years from an API of 30 to an API of 34. So you have seen a lightening of that crude. And now, the U.S. basically does not import any light sweet crude at all. It imports a little bit of medium, but not much at all compared to where it was. And it really only imports heavy sour crude. That's 75% of the heavy sour crude now comes from Canada. 2/3 of total U.S. oil imports coming from Canada now. Raw Canada. And on top of that, you also get barrels from, heavy barrels from Mexico, increasingly from Venezuela, which was, again, what I was doing all in January and February until this started happening with Iran. If they begin to muck around with trade, there's two risks here. One is the inability to get rid of barrels you don't need. This is the light sweet barrels that we can't kind of see or that U.S. refiners don't want to consume. That's why they're currently being exported. And the other risk here is the risk of reciprocal restrictions. That if the U.S. starts doing this, then you start this kind of chaos spiral that you would have seen in like prior tariff wars and things in trade wars in the past. Once one country starts restricting trade, other countries are going to feel political pressure to do similar. In that case, then yes, the U.S. would begin to feel could run out of heavy sour crude on the balance. Probably not Canada, because Canada's landlocked in this case. It's going to have to supply the U.S. market, but other countries might not. Venezuela also feels relatively captive in the situation, so I think it'll probably continue. It's now, in some ways, almost a colony of the Trump administration. So I think that would continue going through. But I think the bigger issue is not the availability of sour or heavy sour imports. It's the inability to get rid of that light sweet export. That if you can't do that, this is when you're going to drive down the local price of WTI, and you would end up kind of pushing domestic producers to eventually cut back production, or at the very least, not produce as much as they would if they were being able to realize $150 or $200 crude.
Sorry, why couldn't U.S. export the light sweet? Because of the
ban? So if there's a crude oil export ban, I think a refined product export ban is more likely for this reason, because I think that a crude oil export ban actually doesn't even help that much in the interim, at least absent and all. Maybe they could do both, and then it could theoretically help briefly before it wrecked everything. But I do think that if you did ban the export of crude oil, the U.S. market itself can't really process that much for that long, and you'd see U.S. inventories spike at a moment where global inventories are plummeting, and domestic oil producers in Texas and New Mexico, et cetera, would basically get a worse and worse price, so their incentive to drill would fall, and eventually they'd run out of places to put it, and you kind of end up at really, really weak prices, and that would end up in a worse situation for the United States and a much worse situation for the world.
What are you going to be writing about in your piece that's going to come out on Friday, March 20th? What are you going to be paying attention to in the next few days?
Yeah. So my Oil Context Weekly report, it's always a bit of a chaotic sprint at the best of times. But no, we're talking about everything from the rising price of maritime war insurance in the Middle East, and the fact that even at those insane prices, the economics still clear. And despite that, we're not seeing passage. So obviously there's something else, kind of a legitimate fear of harm, or this kind of continual belief that Trump is about to back at it at any moment. And why spend $5 million if tomorrow I can go for free, right? There's going to be, there's been accelerated relief on sanctions of Venezuelan oil, of Russian oil. There's even been increasing pressure in Eastern Europe on the EU in Brussels to ease up restrictions on and ease up the EU import ban on Russian oil, and basically refill the Druzhba pipeline, which has been running mostly empty since the invasion of Ukraine and the sanctions and the import ban thereafter. Then you also have things like, the curve weirdness and the fact that you are seeing WTI at such an extreme premium. Basically, all the things we talked about are the things I'm going to be writing about on Friday. And then, Jones Act, Iranian tax picking up on physical infrastructure in addition to the kind of shipping. It's a stream of consciousness mess, very frankly.
What happens if oil goes to 200, 250? How does the price of oil get back down?
The quickest and easiest solving mechanism in my mind is that the oil price is going to continue rising until Trump just one day says it's over. He's going to post something on Truth Social. His superpower is that he can move goalposts. He can create the conditions for victory kind of, out of his sleeve. That's what I think he'll do. He'll say, the Ayatollah is dead. We killed the supreme leader. We wiped out many layers of their government. We sunk their navy. We destroyed their launchers, et cetera, et cetera, et cetera. We're done. And now we're going to, the Middle East is a safer place. Even if that's not true, he will say that. And I think at that stage, it will fall to Iran as to whether or not they buy that and whether or not they let up their attacks. I think that at the end of the day, Iran wants this to end as well. They do not want the regime to fall. They want the bombings to stop. So I do think eventually they will yield and cede and pull back. But again, then we end up in a really complicated and kind of durably problematic kind of middle ground. And again, this is why there's always a sentiment, I think, in the Trump administration of like, all my predecessors were cowards. They didn't, all I needed to do was use the might of the US military and we could just solve any problem in the world. And that worked really well in Venezuela. And I think he got overly confident. And then they thought, Iran was Venezuela and the political culture of Tehran was the political culture of Caracas. And it could not have been further from the truth.
Rory, I know a lot of oil analysts often talk about the word spare capacity. What does that mean? What is spare capacity right now? And what are the consequences of that answer?
The spare capacity right now, in a real way, is functionally zero. Normally, when we talk about spare capacity, we talk about basically how much production capacity OPEC has cut back. When at the peak of the COVID cuts in 2020, we probably had upwards of 10, 11 million barrels a day of spare capacity. And this is capacity usually defined as capacity that could come on quickly and last for a certain amount of time. Kind of durable emergency reserves of production levels.
Yeah, like in Texas, whatever we're producing in Texas now or anywhere around the world that's not in the Middle East, to produce more, you have to invest and it takes months, years. The point of the Middle East is that it's so available, they can just, stick the straw down a little bit more and produce more instantly. And normally that figure is millions of barrels a day.
Yes. And I think even historically, Texas actually did have spare capacity when the Texas Railroad Commission kind of managed production levels, the initial kind of OPEC market controller. But now, everyone basically in the West, in any kind of free market economies, everyone's producing full out because it doesn't make sense to hold, you're leaving money on the table. For OPEC countries, it was always a means of market management, a means of geopolitical influence, kind of soft power, but also hard power. That I think, and what part of this crisis has revealed, and I think this is always known, but again, we'd never seen the Strait closed, even during the tanker wars in the 80s. Hormuz and Iran short circuits the market's normal response mechanism, which is tapping into that spare capacity, because virtually all that spare capacity was in Saudi Arabia, the UAE, Kuwait, these GCC producers, these core of OPEC. And all the spare capacity is now on the wrong side or the bad side of the Strait.
Right. And just to give numbers on this in terms of the amount of oil exports that are down, Iran exports down 30%, Iraq oil down 67%, Kuwait down 59%, Qatar 62%, Saudi Arabia 35%. So it's not looking good. Rory, thank you so much for coming on.
Thanks for having me, Jack.
Thank you for listening. Remember, today we have a special offer for Monetary Matters listeners. Go to the link in the description to save 20% on annual subscriptions to Commodity Context. This offer is available till March 26th and is for annual subscriptions only. I think Rory's work is a vital toolkit to have in 2026. Go check out the discounted offer in the link in the description. And remember that on Substack, if you aren't already subscribed, you must first enter your email to access the discounted checkout page. Until next time.
Thank you. Just close the door.